What is behavioral economics?
A field that combines insights from psychology and economics to explain why people often make decisions that deviate from the predictions of standard rational choice models.
Who are Daniel Kahneman and Amos Tversky?
Israeli-American psychologists who pioneered research on cognitive biases and prospect theory, fundamentally reshaping the field of behavioral economics.
What is prospect theory?
A theory developed by Kahneman and Tversky, 1979, stating that people evaluate outcomes relative to a reference point and are more sensitive to losses than to equivalent gains.
How does the value function in prospect theory differ from standard utility theory?
The value function is S-shaped, concave for gains, risk aversion, and convex for losses, risk-seeking, and it is steeper for losses than for gains.
What is a reference point in prospect theory?
The baseline against which outcomes are judged as gains or losses. It is often the status quo or an expectation level, not an absolute wealth measure.
What is loss aversion?
The empirical finding that losses loom roughly twice as large as gains of the same magnitude, i.e., losing $100 feels about twice as painful as gaining $100 feels pleasurable.
What is the typical loss aversion coefficient, lambda, found in experiments?
Approximately lambda is almost equal to 2.25, meaning a loss is psychologically weighted about 2.25 times more than an equivalent gain.
How does loss aversion affect investor behavior?
Investors tend to hold losing stocks too long, hoping to break even, and sell winning stocks too early, locking in gains, a pattern called the disposition effect.
What is the disposition effect?
The tendency of investors to sell assets that have increased in value while keeping assets that have decreased in value, driven largely by loss aversion.
How does loss aversion influence labor supply decisions?
Studies of taxi drivers show they set daily income targets and quit early on high-demand days while working longer on slow days, contrary to rational supply predictions.
What is the endowment effect?
The phenomenon where people value an object more highly simply because they own it, leading to a gap between willingness to accept, WTA, and willingness to pay, WTP.
Who first demonstrated the endowment effect experimentally?
Richard Thaler coined the term, and classic mug trading experiments by Kahneman, Netsch, and Thaler, 1990, provided strong experimental evidence.
How large is the typical WTA/WTP gap in endowment effect experiments?
Sellers typically demand roughly 2 to 3 times the price that buyers are willing to pay for the same object.
What explains the endowment effect under prospect theory?
Giving up a good is coded as a loss relative to the ownership reference point, making it feel more costly than the gain a buyer anticipates.
How does the endowment effect impact real estate markets?
Homeowners often set asking prices anchored to their purchase price, refusing to sell at a loss even when market conditions have changed significantly.
What is mental accounting?
A concept introduced by Richard Thaler describing how people categorize, evaluate, and track financial activities in separate mental accounts rather than treating money as fungible.
Give an example of mental accounting in everyday life.
A person might refuse to spend $50 from a savings account on dinner but happily spend a $50 gift card on the same meal, even though both have equal monetary value.
What is the house money effect?
The tendency to take greater risks with money perceived as winnings, e.g., casino profits, because it is mentally categorized as free money rather than personal wealth.
How does mental accounting explain the sunk cost fallacy?
People continue investing in a failing project because they have a mental account tracking prior expenditures and feel compelled to justify those sunk costs.
What is narrow framing in mental accounting?
Evaluating each financial decision in isolation rather than considering it as part of a broader portfolio, leading to suboptimal risk management.
What is nudge theory?
A framework by Richard Thaler and Cass Sunstein proposing that subtle changes in choice architecture can steer people toward better decisions without restricting freedom of choice.
What is a nudge according to Thaler and Sunstein?
Any aspect of the choice architecture that predictably alters behavior without forbidding options or significantly changing economic incentives.
What is libertarian paternalism?
The philosophy behind nudge theory, designing environments that guide people toward welfare-enhancing choices while preserving their freedom to choose otherwise.
Give an example of a successful nudge in retirement savings.
Auto-enrollment in 401k plans dramatically increases participation rates because the default option is set to enrolled rather than not enrolled.
What is a default option nudge?
Setting the pre-selected choice to the socially or individually optimal option, exploiting the tendency of people to stick with the status quo.
How has nudge theory been applied to organ donation?
Countries with opt-out, presumed consent systems have much higher organ donation rates than opt-in countries, illustrating the power of defaults.
What is bounded rationality?
A concept by Herbert Simon stating that human decision-making is limited by available information, cognitive capacity, and time constraints, leading people to satisfice rather than optimize.
What does it mean to satisfice?
To choose an option that is good enough to meet a minimum threshold of acceptability rather than searching for the theoretically optimal solution.
How does bounded rationality differ from full rationality assumed in neoclassical economics?
Neoclassical models assume agents process all available information and maximize utility perfectly, while bounded rationality acknowledges cognitive limitations and the use of heuristics.
What are heuristics in behavioral economics?
Mental shortcuts or rules of thumb that simplify decision-making, often useful but sometimes leading to systematic biases and errors.
What is the availability heuristic?
Judging the probability of an event based on how easily examples come to mind, leading to overestimation of dramatic or recent events, e.g., plane crashes.
What is the representativeness heuristic?
Judging probabilities based on how closely something resembles a prototype, often ignoring base rates and leading to conjunction fallacies.
What is the anchoring effect?
The cognitive bias where people rely too heavily on the first piece of information, the anchor, encountered when making subsequent judgments or estimates.
How does anchoring affect price negotiations?
The initial asking price serves as an anchor. Even arbitrary starting points significantly pull final negotiated prices toward the anchor value.
How does anchoring manifest in financial markets?
Investors anchor to metrics like 52-week highs, IPO prices, or round numbers, which can distort valuation judgments and trading behavior.
What did Kahneman and Tversky's Wheel of Fortune experiment demonstrate about anchoring?
Participants who spun a rigged wheel gave estimates of African UN membership that were strongly influenced by the arbitrary number the wheel landed on.
How do analysts' price targets demonstrate anchoring bias?
Analysts often anchor to previous price targets or consensus estimates, adjusting insufficiently even when fundamentals change dramatically.
What is herd behavior in economics?
The tendency of individuals to mimic the actions of a larger group, often disregarding their own information or analysis in favor of following the crowd.
What causes herd behavior in financial markets?
Factors include informational cascades, inferring information from others' actions, social pressure, and the career risk of deviating from consensus.
What is an informational cascade?
A situation where individuals sequentially observe others' decisions and rationally choose to follow them, ignoring their own private signals, potentially leading the group astray.
How does herd behavior contribute to market bubbles?
As more investors buy into a rising asset, others follow based on social proof rather than fundamentals, inflating prices far beyond intrinsic value.
What is a speculative bubble?
A market condition where asset prices rise to levels significantly above fundamental value, driven by exuberant buying and the expectation that prices will continue to increase.
Name a famous historical market bubble.
The Dutch tulip mania, 1637, where tulip bulb prices reached extraordinarily high levels before collapsing dramatically.
What was the dot-com bubble?
A speculative bubble in late 1990s, 2000 where internet company stocks soared based on hype and optimism, then crashed when expected revenues failed to materialize.
What role did behavioral biases play in the 2008 housing crisis?
Overconfidence, herd behavior, and mental accounting led homebuyers, lenders, and investors to underestimate risk and fuel unsustainable housing price appreciation.
What is overconfidence bias?
The tendency for people to overestimate their own knowledge, abilities, or the precision of their predictions, common among investors and fund managers.
How does overconfidence affect trading volume?
Overconfident investors trade excessively, believing they can outperform the market, which typically leads to lower net returns after transaction costs.
What is the certainty effect in prospect theory?
People disproportionately prefer outcomes that are certain over those that are merely probable, even when the expected value of the probable outcome is higher.
What is the LA's paradox?
A decision-making paradox showing that people violate expected utility theory by preferring certainty in some gambles while choosing risky options in structurally identical ones.
What is the isolation effect, also called the cancellation effect?
The tendency to disregard components shared by all options and focus on what differs, which can lead to inconsistent preferences depending on how choices are framed.
What is framing effect?
The phenomenon where people's decisions are influenced by how information is presented, e.g., 90% survival rate versus 10% mortality rate, rather than by the objective facts alone.
How did Kahneman and Tversky demonstrate framing effects?
In the Asian disease problem, participants preferred a sure option when outcomes were framed as lives saved, gains, but chose the risky option when framed as lives lost, losses.
What is status quo bias?
The preference for the current state of affairs, where changes from the baseline are perceived as losses and thus resisted even when change would be beneficial.
How does status quo bias relate to loss aversion?
Any change from the status quo involves potential losses in some dimensions, and because losses loom larger than gains, people disproportionately favor staying put.
What is the decoy effect, asymmetric dominance?
Adding a third, clearly inferior option, the decoy, to a choice set to make one of the other options appear more attractive by comparison.
What is present bias?
The tendency to give disproportionate weight to immediate payoffs over future ones, leading to procrastination and undersaving for retirement.
What is hyperbolic discounting?
A model of intertemporal choice where discount rates are higher for near-term delays and lower for delays further in the future, unlike the constant rate in exponential discounting.
How does hyperbolic discounting explain procrastination?
The immediate cost of effort is heavily weighted while the future reward is deeply discounted, making it always seem optimal to delay action.
What is the concept of choice overload?
Having too many options can paralyze decision-making, reduce satisfaction, and lead to suboptimal choices, as shown in Iyengar and Lepper's jam study.
What did the famous jam study by Iyengar and Lepper find?
Shoppers who saw a display of 24 jams were less likely to purchase than those who saw only 6 jams, demonstrating that excess choice can reduce action.
What is the peak-end rule?
People judge an experience based on how they felt at its most intense point, peak, and at its end, rather than on the sum or average of every moment.
How did Kahneman demonstrate the peak-end rule?
In colonoscopy experiments, patients rated a longer but gradually easing procedure as less painful than a shorter one with an abrupt end, despite more total discomfort.
What is the sunk cost fallacy?
The tendency to continue an endeavor because of previously invested resources, time, money, effort, rather than evaluating future costs and benefits objectively.
How does the sunk cost fallacy manifest in business decisions?
Companies may continue funding failing projects because executives feel compelled to justify the resources already spent, rather than cutting losses.
What is regret aversion?
The tendency to avoid actions that might lead to future regret, often causing investors to make overly conservative choices or follow the herd.
How does regret aversion differ from loss aversion?
Loss aversion concerns the pain of actual losses, while regret aversion involves the anticipated emotional pain of having made a wrong decision.
What is the Dunning-Kruger effect and how does it relate to market behavior?
People with low competence overestimate their abilities while experts may underestimate theirs, contributing to novice investors taking on excessive risk.
What is the gambler's fallacy?
The mistaken belief that past random events affect future probabilities, e.g., thinking a coin that landed heads 5 times is due 4 tails.
How does the gambler's fallacy affect trading?
Traders may expect a stock on a losing streak to reverse simply because it has fallen for several consecutive days, ignoring actual market conditions.
What is confirmation bias?
The tendency to search for, interpret, and remember information that confirms pre-existing beliefs while ignoring contradictory evidence.
How does confirmation bias affect investors?
Investors seek out news and analysis that supports their positions, creating an echo chamber that prevents them from recognizing when to exit a losing trade.
What is the hindsight bias?
The tendency to believe, after an event has occurred, that one always knew it would happen, distorting memory and lessons learned from past decisions.
What is the effect heuristic?
Making judgments based on current emotions rather than objective analysis. For example, fearing investments in industries one has negative feelings about regardless of fundamentals.
What is myopic loss aversion?
The combination of loss aversion and frequent portfolio evaluation, leading investors who check returns often to take less risk because short-term losses feel painful.
How did Benartzi and Thaler use myopic loss aversion to explain the equity premium puzzle?
They showed that if investors evaluate portfolios annually and are loss-averse, they would demand a high premium for stocks, matching observed equity premiums despite rational models predicting lower premiums.
What is the equity premium puzzle?
The observation that stock returns have historically exceeded bond returns by a margin too large to be explained by standard risk aversion models.
What is time inconsistency in behavioral economics?
When a person's preferences change over time such that what is preferred at one point is no longer preferred later, even without new information.
What are commitment devices?
Strategies people use to lock themselves into future behavior, overcoming present bias. Examples include automatic savings deductions and public goal announcements.
What is the IKEA effect?
The tendency for people to place disproportionately high value on products they partially created, regardless of the quality of the outcome.
How does the endowment effect apply to stock trading?
Investors may demand a higher price to sell a stock they own than they would be willing to pay to buy the same stock, creating market inefficiencies.
What is social proof in behavioral economics?
The tendency to adopt the behavior of others in a group, assuming that the group's collective action reflects correct behavior, especially under uncertainty.
How is social proof used as a nudge?
Showing messages like 9 out of 10 of your neighbors reduced their energy use effectively encourages conservation through conformity to perceived norms.
What is the money illusion?
The tendency to think of money in nominal terms, face value, rather than real terms, adjusted for inflation, affecting spending and wage negotiations.
What is fairness bias and how does it affect markets?
People are willing to punish unfair behavior even at personal cost, as shown in ultimatum games, which can affect pricing, wages, and market transactions.
What did the ultimatum game reveal about rational self-interest?
Responders frequently reject low offers, e.g., less than 20% of the total, even though accepting would be financially rational, demonstrating fairness preferences.
What is the hot hand fallacy?
The mistaken belief that a person who has experienced success has a greater chance of further success in random or independent events.
What is ambiguity aversion, Ellsberg paradox?
People prefer known risks over unknown risks, choosing gambles with known probabilities even when the expected values are identical.
How does ambiguity aversion affect investment decisions?
Investors favor familiar domestic stocks over foreign equities, home bias, preferring known risks even when international diversification would improve returns.
What is the home bias in investing?
The tendency for investors to overweight domestic securities in their portfolios despite potential gains from international diversification, partly driven by ambiguity aversion and familiarity bias.
What is default effect in choice architecture?
The powerful tendency for individuals to accept preset options, making the design of defaults one of the most impactful tools in behavioral policy.
How does Thaler's Save More Tomorrow program use behavioral insights?
It combines present bias, commitment starts in the future, loss aversion, increases tied to pay raises, and inertia, auto-escalation, to dramatically boost retirement savings.
What is the winner's curse in behavioral economics?
In auctions, the winning bidder often overpays because the winner tends to be the person who most overestimated the item's value.
What is mental accounting's payment depreciation concept?
The psychological pain of paying for something diminishes over time, which is why prepaid vacations feel free and why people prefer flat-rate pricing.
What is narrow bracketing?
Making decisions one at a time instead of considering them as part of a broader set, leading to choices that may be locally sensible but globally suboptimal.
How does prospect theory explain insurance purchasing behavior?
People buy insurance even at unfavorable premiums because the utility of eliminating a potential loss, which weighs heavily, exceeds the disutility of the certain premium payment.
What is the reflection effect in prospect theory?
Risk preferences reverse between the gain and loss domains. People are risk-averse for gains but risk-seeking for losses.
What are Kahneman's System 1 and System 2?
System 1 is fast, automatic, and intuitive. System 2 is slow, deliberate, and analytical. Many biases arise because System 1 dominates routine decisions.
How does System 1 thinking contribute to anchoring?
System 1 automatically generates an initial estimate based on the anchor, and System 2 insufficiently adjusts from it, leaving the final judgment biased toward the anchor.
What is choice architecture?
The practice of designing the environment in which people make decisions, including option layout, defaults, and information presentation, to influence outcomes.
What is the distinction between econs and humans in Thaler's framework?
Econs are the perfectly rational agents of economic theory. Humans are real people who use heuristics, have biases, and are influenced by context and emotions.